Disney is the happiest place on earth, but Disney stock has not been the happiest place to be an investor over the last several years. 2 minutes on Disney stock and the three-act play that is their downfall, their up movement, and why we think there might be value in Disney stock going forward. I'm Rob Haugen from River1 Asset Management, and let's start at Act 1 of the play that is Disney, and we're going to go back to the year 2018. This was the heyday for Disney, doing about $60 billion in revenue, and take a look at how great the net income margins are right here, 18%. This was the heyday, and then bam, Bambi's mom falls in the forest, dark days ahead. Let's take a look at what happened in Act 2 for Disney. Here are the dark years for Disney. We're talking about 2020 through 2023, and obviously COVID was a really bad time for Disney. The parks weren't full, the movie theaters weren't full, and you can understand why that net income margin, remember we looked at that one, 18%, fell all the way to 2%. Very understandable, but what everyone expected was it to pop back up to where it was, and it did not. 4, 7, 6% net income margins. What happened to their business model? Well, people started going to the theater less, but what really happened is they started cutting cable, and the two biggest money makers in cable television were ESPN and the Disney Channel, and they were getting hurt over and over in these dark days for Disney. But we think that there's value in Disney. We think that this three-act play has an epic comeback coming their way. Take a look at what margins have gone to. Remember 2% in 2020? That is now 9%, headed in 2026 to 12% and generally increasing. They have fixed the direct-to-consumer business somewhat, but we think there's actually probably a better push within these. Maybe they could even get to 18, and here's why. Take a look at the amalgamated direct-to-consumer that Disney is putting out. They have Disney Plus, which they built themselves. They also have Hulu, which they bought, and ESPN Plus, and here's the problem. Each one of these three businesses has its own P&L, has its own C-suite, has its own tech stack, and all of it is costing Disney way more money than Netflix. Why do we think that Disney net income can go back up and go even higher than the model has? Because Netflix already does it. They have one tech stack. They have one CEO, not three. All of these things can be consolidated. There's at least $1 billion of consolidation savings in these three, probably more. All of these things can lead Disney to being much more effective as a moneymaker. That revenue growth has never been a real problem for them. If they can get margins up, we think that there's a lot of value in this stock. You could see $9, $10 in earnings. You put a 20 multiple on $10, that's 200 versus the 96 it's trading today. You've got a lot of value that may be in a future Disney. If you like this pitch, we do them on a regular basis. You can subscribe on social media, or we do put out a morning note every day with all of our insights, things that we're looking at, all the thoughts on the market. Could help you in your investing world. If you want to subscribe to it, please do.